Hello dear students, Assalamu alaikum. I hope and I pray that all of you are doing good by the grace of Almighty. I'm your tutor Munir Muhammad Shafi, and we'll be kickstarting our practice, our question focus, our exam focus practice for the paper of strategic business reporting for the upcoming examinations. And in today's video, in this session, we would be looking at a past exam question, which is called Benito Go. This question is from December 2023 attempt. It has already been rolled out in our planner about these questions which we are going to attempt. So it's December 2023 exam sitting, and this is a good question on sale and lease back. A bit about this question, a bit about the approach which we are going to follow. So obviously first of all, we are going to analyze the question. We will be analyzing the requirements, how we are going to approach the question, and drafting is the key to success. So my focus will be on how we approach drafting an answer. Okay, so I'll try to break down the requirements. I'll try to dissect the content for you so that it can be understood in digestible chunks. It can be easier for you to grasp the techniques of drafting. Okay, I'll try my level best to make this thing easy so that you can ace your drafting techniques, because obviously this matters a lot. We know that strategic business reporting is not a number game. Okay, marks and calculations are limited, but your analysis, your explanation, your application of the accounting principles holds key to passing this paper. Okay, so let's start the question. Let's start discussing the question. Benito Go. So first of all, the approach to start the question, the approach to target the question is that first of all, you're supposed to read this preface. Okay, I've converted it into PDF files so that I can use these tools, these PDF tools, to make this session interactive, to focus what I'm trying to convey to you, to highlight things up easily. So this, first of all, as we start approaching the question, we have to first read this preface of the question. The introduction to the question. So, Benito Co. is in the real estate industry. The financial year end of Benito Co. is 31st of December 2007. Okay, so financial year end is also very important. So year end is 31st of December 2007. The following exhibits available on the left-hand side of the screen provides information relevant to the question. So these are the exhibits which will be providing information about the questions. And there's only one exhibit. The good thing is there only is one exhibit. Not a difficult question, an easy one. And that exhibit is about the sale and lease back. So this exhibit describes a sale and lease back transaction with OT & Co. and the key performance indicators that are affected by the sale and lease back. Obviously, the sale and lease back transaction do have implications on key ratios of the company. So we haven't yet read the requirements, but this is very obvious that the question is going to ask you about those implications. This information should be used to answer the question requirements within your chosen response options. So these are the response options. You have to respond. You have to draft your responses in these response options. So the first exhibit is the sale and lease back. But before going to read this exhibit, we will be first reading the requirements. Okay. Since I've converted into PDF. Okay. So this is the requirement section on your screens. I hope on your screens. Yeah. Okay. In accordance with IFRS accounting standards. So A requirements says that in accordance with the IFRS accounting standards, describe how an entity assesses whether the transfer of an asset qualifies as a sale in sale and leaseback accounting. So basically, this requirement is asking accounting treatment about how entity assesses whether the transfer of an asset qualifies as a sale in the sale and leaseback accounting. Then it asks, explain how sale and leaseback transactions are dealt with by the seller lessee in accordance with IFRS 16. Seller lessee, the one who has sold and then leased back. The one who has sold is no more the owner, and then that company has leased back. Now that company is the lessee. So seller lessee. If the transfer of an asset qualifies as a sale, then how the sale and leaseback transaction are dealt by seller lessee. Treatment for seller lessee. Okay, third one, explain how sale and leaseback are dealt by seller lessee. The previous one was if the transfer qualifies as a sale, if the transfer does not qualify as a sale. And the fourth one is explain the effect on the accounting treatment if sale and leaseback agreement contains a call option. That's interesting. Under which the seller lessee can, at its option, repurchase the property. And the best thing is there is no need to refer any exhibit to answer part A. This simply means that this is a knowledge-based requirement for 9 marks, which will obviously be followed by a practical requirement, which is in front of you, which is of 7 marks. So in short, these 9 marks are easily grabbable, and those who can easily grab these 9 marks can easily grab these 7 marks by simply applying this to this requirement. So a good thing is that when we will be discussing the solution to part A, basically we will be revising IFRS 16's requirement relating to sale and leaseback. So the A part will easily make some revision, some basic revision, and then when we will be applying all those concepts to part B, that will be the practice for its application. So part B says, using exhibit 1, you have to explain in accordance with IFRS 16 the accounting entries for the sale and leaseback transaction in the financial statements of Benito Co. if the head office transfer qualifies as a sale and does not qualify as a sale. So you need to explain the accounting implication and accounting entries if this is a sale part, if case number 1 this is a sale, case number 2 if this is not a sale. Then part C talks about the KPIs. So we can discuss this later, but we can easily target these 2 requirements, A and B. Okay. And for A, in order to target A, we are even not supposed to refer exhibit 1. Are you getting this? Okay. So let's get back to this. Describe how an entity assesses whether the transfer of an asset qualifies as a sale. Just think about it, and then we'll try to jot down some pointers that what should we be writing, or what, for example, if you are planning this requirement, what are the major chunks? What are the major bits which you should be explaining in this part? For example, I'm simply giving you a hint. For example, if this qualifies for a sale, asset might be derecognized in the financial statements. If this qualifies as a sale, part A is describe how an entity assesses whether the transfer of an asset qualifies as a sale. So when a sale is recognized, the sale is recognized when the performance obligation is satisfied. If I talk about A1, assessing This transaction is sale transaction. Performance obligation. Control transferred. Isn't it? Performance obligation satisfied, control transferred. If this is the case, that's a sale. Very easy. Then A2. Explain how the sale and leaseback transaction are dealt with by seller lessee in accordance with IFRS 16 if the transfer of an asset qualifies as a sale. Just think of the accounting treatment. I'm giving you 2 minutes. Think of it on your own self, and then we will discuss. Okay, so I hope you have already jotted down those pointers. And if you talk about A2, accounting treatment for seller lessee. What could be the planning pointers? Okay. So, derecognition of an asset. Then, if it's a sale, asset will be derecognized. Gain / loss on disposal in P&L. Then right of use of asset. Right of assets use if it's a lease transaction. Lease liability will also be recognized. Then, if there is any excess or below fair value adjustment, we have to account it for. And then we have subsequent treatment. Subsequent treatment, the right of use of assets will be depreciated and the liability will be unwound, and as per the interest rate implicit in the lease, the financing components, interest cost will go to P&L. Simple. Now you have to take 2 minutes and you have to think of the accounting treatment for this part. What happens if this does not qualify as a sale? Just think of it, and we'll resume once you have thought it. I hope that you might already have thought over this requirement. Explain how the sale and leaseback transaction are dealt by the seller lessee if the transaction does not qualify as a sale. That's very easy. A3. Accounting treatment if not a sale. That would simply asset continue to be recognized in financial statements, and financing will be a liability That's price 32. Are you getting this? Then the last thing is Explain the effect on the accounting treatment if sale and leaseback agreement contains a call option. If it contains a call option, then that simply means that the one who has sold, the seller, has the control over the asset. The control has not passed to the buyer. We have the continuing involvement. The control has not passed, and this is not even a sale. Simple. Are you getting this? Easy. So whatever we have discussed, let's see that how we are going to actually draft it. I hope all the accounting concepts have been revised, and now let's see what if and how we are going to draft it. Very simple. We do not need to be very much technical if you are to gain these marks. Keep it simple, keep it straightforward, and all marks will be in your kitty. So let me open the solution for you so that we can go through it. Here is the suggested solution in front of you. We have already jotted down these requirements. The first part was assessing whether the transfer qualifies as a sale. So first of all, we will be giving IFRS 15 guidance. A sale is considered to occur when the seller satisfies a performance obligation by transferring the control. And what is the control? We will further describe what is the control. Control refers to the ability to direct the use of the asset and to obtain substantially all of its benefits. If you have described this, done and dusted. Moving on. Accounting treatment if the transfer qualifies as a sale. We have already jotted down these pointers. Derecognition of the asset. The seller lessee removes the asset from the balance sheet. Right of use asset. Recognize a right of use asset measured based on the proportion of carrying amount that reflects the rights retained by the seller lessee. The proportion of the rights retained as per IFRS 16 will be recognized as the assets. For example, if the asset has 100 years life and we have retained 20 years of life of the asset, then we are going to recognize the right of use of asset for those 20 years. Then we will be recognizing lease liability. Recognizing the lease liability calculated as the present value of the future lease payments. We know how to do this. Okay. Then profit or loss recognition. Report a profit or loss based on the rights transferred to the buyer lessor. Fair value adjustments. If the consideration received exceeds the fair value, the excess component is the additional financing. If the consideration is below fair value, then treat as the prepayment for the lease payments. Simple. And then subsequent treatment, we will be depreciating it, and interest charge will be recognized. Accounting treatment if the transfer does not qualify as a sale. Asset recognition. The seller lessee continues to recognize the assets in its balance sheet. No derecognition will take place. And the proceeds from the transfer are accounted as the financial liability in accordance with IFRS 9. It's liability as per IAS 32 and will be accounted for as per IFRS 9. Getting? Effect of an agreement containing a call option. Effect of an agreement containing a call option. Call option impact. A call option allowing the seller lessee to repurchase the property typically precludes sale accounting under IFRS 15. As I told you, it has the continuing involvement. Control is retained. The existence of the call option means the seller lessee retains the control, so the asset remains on the balance sheet. Cash received is treated as the financing liability. And this is very important. Simple, straightforward, without unnecessary elaboration, without unnecessary examples. You are done and dusted. Keeping simple, straightforward, but the structure should be very clear in your mind. That how are you going to divide your answer? How are you going to break down the requirements of IFRS 15 and IFRS 16 in relation to sale and leaseback? Are you getting this? We have to move on to part B. So, yeah, okay. So, using exhibit number 1, explain in accordance with IFRS 16 the accounting entries for the sale and leaseback transaction in the financial statements of Benito Co. if the head office transfer qualifies as a sale and does not qualify as a sale. So what will be the accounting entries? So you have to think of those accounting entries. So I'm giving you a few minutes. You have to take your time. You have to think on it. You have to come up with an answer, and then you'll be looking at the further discussion which solves this problem for you. So do use your brains first, because obviously you have to use your brains in the examination as well. Okay, so take your time, solve it, and then get back to this video. So dear students, I hope you might have gone through this requirement. Sale and leaseback. So we have to identify the accounting treatments. We have to explain the accounting treatments. We have to make accounting entry. If it's a sale and if it's not a sale. If it's a sale and leaseback, then what will be the accounting entry? If it is not a sale, then what will be the implication? Well, it's not so technical. It's easy. If you're planning this requirement, okay, let's first read this. On 1st of January 2007, Benito sold its head office, which had a carrying amount of 3.75 million, to Otinco for cash of 7.5 million. On the same date, Benito has entered into a contract with Otinco to use their office for 20 years. Cash consideration 7.5 million, lease for 20 years. Both the company with annual payments payable at the end of each year. Both companies have correctly accounted for the transaction as a sale and lease back. At 1st of January 2007, fair value of head office is 6.75 million. The PV of ALP, present value of annual lease payments, is 5.47. Okay. So what is happening here? So what is happening here basically is he is getting more amount than the fair value. And then PV of ALP is 5.47 million. So if we analyze these two figures, fair value 6.75, cash received 7.5, so we can simply say that the cash exceeds the fair value. It means this amount relates to the financing component. Are you getting this? This amount relates to the financing component. Okay, so let me calculate what is that. It's a 7.5 minus 6.75. So financing component is 7.5 minus 6.75, that is 0.75 million. That is financial liability. Are you getting this? 3.75 million, this will be derecognized. Okay, and the right retained. Okay, so if we see, okay, then if this is the present value of the liability, minus, if we remove this financing component, of 0.75 million, then here comes 4.72, which is basically lease financing. So 4.72 relates to the lease liability. Okay, because if 5.47 is the present value of total payments, it's a total liability, and if out of that 5.47, 0.75 is the financing component, then the remaining one, 4.72, is the lease liability. Are you getting this? Okay, so prima facie, how much gain are we having? See, carrying value is 3.7, fair value is 6.75, so prima facie we are having a gain of 3.3 million, isn't it? Prima facie, I'm again repeating the word apparently, it is giving an impression, it is just giving an impression. For example, it is giving an impression that the apparent gain is $3 million. But are we going to record this 3 million? Answer is no. Why? Because out of this 3 million, how much relates to the lease component, the lease retained? So basically 4.72 is the lease retained out of 6.75 into 3 million. That comes out to be so if we calculate out of this 3 million, 2.1 gain, this portion relates to the rights retained and will not be recognized in profit or loss. So how much will be recognized? The balancing one. The easy approach. The balancing will go as a gain. Are you getting this? Simple as easy as that. And how much is the right retained? Very easy. What's the carrying value of the asset? The carrying value of the asset is this is basically the right retained. The carrying value of the asset multiplied by the present value of lease liabilities divided by the fair value. It's 2.62. So if we try to make an entry, debit will be cash, debit will be right of asset, credit will be gain, which will go in profit and loss, credit will be asset, and credit will be total liability. Lease liability plus financial liability. So the cash received is 7.5. Right of asset is 2.62. Gain goes is 0.9. Asset derecognized 3.75. And lease liability plus financial liability is 5.47. I hope this balances the entry. If the entry is out by 0.1 or 0.2, you can take care of that. Primarily, this will be accounting entry. Are you getting this? Simple as easy as that. And if the asset is not sold, if the criteria of sale as per IFRS 15 is not met, then obviously the asset will not be derecognized, no lease liability will be booked. That will simply be a financial liability. Are you getting this? So let us have a look at the solution, how it will going to be drafted. Okay. If the head office transfer qualifies as a sale, then access over fair value we have already discussed. Since the sale price of head office exceeds the fair value, this will be recognized as the additional financing. Lease payment, the present value of annual lease payments is 5.47. Is split into, if 0.75 is the additional financing, then 4.72 is relating to lease. Right of use asset we have already discussed. It'll be 2.62 based on the portion of the previous carrying amount relating to the right of the use retained. Then we have the gain on sale we've already discussed. Out of 3 million, 0.9 million will be recognized and 2.1 will be relating to the rights retained, so will not be recognized. And this entry we have already discussed. Head office transfer does not qualify as a sale, then asset retention, the head office remains recognized by Benito Co. at its carrying amount of 3.75 million. Financial liability is recognized. The entire amount will go to the financial liability, and this will be the financial liability. Are you getting this? Simple as easy as that. Okay, so now I would request you to have a look at the last requirement, which is about KPIs, how this sale and lease back will be impacting KPI. That's a simple requirement. Test of your basic accounting knowledge of primarily relating to the previous paper, financial reporting. Give it a thought, try it on your own, and then pause this video, try it on your own, then resume it to see the discussion. Okay, so dear students, let's see the last bit as well. Part C, using Exhibit 1, compare the impact of the head office transfer qualifying as a sale and not qualifying a statement and key performance and not qualifying as a sale. Compare the impact of head office transfer qualifying as a sale and then not qualifying as a sale on Benito Co's financial statements and key performance indicators. Okay, and here you are also may get 2 professional marks for the quality of discussion regarding the effects on the financial statements. So it's quite simple. As far as the gearing is concerned, the examiner has also given you the ratios. So pay additional thanks to the examiner. Debt upon equity, if it's not a sale versus a sale. So if it's not a sale, then debt value will be higher, obviously. Okay, because the entire cash will be treated as debt. Okay, the entire 7.5 million will be treated as debt. Otherwise, this amount will be treated as a liability. So if it is not a sale, the gearing will increase. Okay, not a sale. So this will be higher. Earnings before interest and tax, if it's not a sale, then earning before interest and tax will be lower because depreciation will be based on the carrying value of the assets that's higher than 2.62. Okay, then if it's not a sale, then the depreciation would be at 3.75 million, which is higher amount, okay, obviously. Then asset turnover will be lower because assets value will be higher. Simple. And return on capital employed, because EBIT will be lower, so return on capital employed will also be lower. Okay, because EBIT will be lower and financial liabilities will be higher. So if it's not a sale, then return on capital employed will be lower. Okay, so let's see. Impact on financial statements. The decision on whether the sale and leaseback can be treated as a sale has significant effects on financial matrices. Okay, if it is not qualified as a sale, assets and liabilities will be greater. Assets will be higher, liability will be higher. Okay, liability recorded for the received cash, loan covenants. Higher debt may lead to potential breaches of loan covenants. Profitability impact, depreciation will be higher, interest charge will be higher, profit, there will be no gain, okay, on the sale of asset. And what about KPIs? If we talk about the gearing will be higher, as I already told you. Okay, debt will be higher. I think we note it down as higher, yes. EBIT will be lower due to higher depreciation. Asset turnover will be lower. And here, return on capital employed will be lower due to, sorry, apologies, it's a typo mistake. Due to lower EBIT. And higher financial liabilities if the asset is not sold. If the transactions qualifies as a sale, depreciation and interest will reduce, EBIT will be higher, and consequently, the arrows will move up and down. I think that simplifies the entire question, and that's crystal clear to all of you. I hope and I pray that everything is crystal clear. And such questions will be a piece of cake for you if you attempt on your own in the future. Getting? So, dear students, thank you very much. Meet you in any other video with another question so that we can help you in your exam practice. Take care a lot. Remember me and all of the teachers in your prayers. Your tutor signing off. Bye-bye.